The stock market is one of those things everyone pretends to understand, like Shakespeare or why your girlfriend's mad at you. So let's demystify investing so one day you too can be featured on Wall Street Bets. Have you ever been to a farmer's market? Look at you. Of course you haven't. But you're familiar with the concept of a market, right? It's a place where you buy and sell stuff. Hope this helped. Like and subscribe for more, and I'll see you next time. The stock market is exactly what it sounds like. It's where investors buy and sell stocks, also called shares, in publicly traded companies. This is important because it allows you to inform dates that you're the co-owner of numerous multi-billion-dollar companies with veracity. It's also important because it's the only way for you and me to own slices of companies like Apple, Nike, or Google. With me so far, people who buy and sell in the stock market are called...
They call themselves apes and R-words? Can they say that?
Investors or shareholders. But you can call me a business deity. And please do. The stock market exists because companies need money to do things, and investors want to make money from their stocks. When people talk about the market, they're generally referring to indexes like the S&P 500, which you can think of as the largest 500 public companies in the US to serve as a benchmark for overall performance and barometer for how close we are to World War III. So, what do you get from playing? Well, investors make or lose money depending on how the companies they invest in perform. For example, if you buy shares of Meta in January, then Mark Zuckerberg goes on camera in February and announces he's sending the Lizard Man army to abduct and emulsify Facebook users into smoothies that extend his life by 13 seconds, your shares might be worth less. But wait a minute, you say, exasperated, and also somewhat nasally. I own part of the company. Don't I get a say in whether Zuck unleashes the Lizardian army on Earth? Sometimes, yeah. Owning stock often comes with voting rights, which allow you to participate in certain corporate decisions like whether the company should accept an acquisition offer or whether the CEO should get paid $1 trillion. However, companies can largely organize shares how they want to. And in Meta's case, two types of stocks exist. So-called Class A stocks, which are what you and I can buy, and Class B stocks owned almost entirely by Mark Zuckerberg. And what's neat is that each Class B stock has 10 times the voting power of a Class A stock. So get ready to become Slurp Juice if you're still on Facebook. Pop quiz, can you buy shares of any company on the stock market? No, you can't buy mine. And if you incorporated an LLC tomorrow, I couldn't buy yours. Why? Because you can't incorporate a company for smoking weed and eating Doritos. Also, because most companies must undergo what's called an initial public offering, or IPO, to become publicly available to invest in. Before an IPO, a company's stock is held by founders, employees, and private investors like venture capital or private equity funds. After an IPO, you and I can log into our Fidelity accounts to buy and sell shares. Basically, some boring stuff happens, a bank gets involved, and a company goes, hey, here's some percentage of me, maybe 20%. Go buy it. And everyone drinks champagne and updates their LinkedIn. Being a public company is generally more annoying than being a private company. You now have financial reporting obligations and shareholders who value immediate growth over long-term planning, which is why you'll occasionally hear about public companies going private, but just remember that an IPO trades some privacy and control for access to money, and you're golden. It's like your mom gives you cash to build a lemonade stand, but also calls every night and demands to know when you're getting married. Now, stock performance tends to be volatile in the short term and more stable in the long term. So if someone's hyperventilating over a 2 basis point change in the market, which means 0.02%, they're likely uninformed. In US history, stocks go up. It's how the system is designed. And this will always happen forever with no negative consequences. Did you watch The Wolf of Wall Street? Some suit on a boat calling a suit in New York who's watching 3 monitors waiting to see a number change 0.03% and scream, buy, buy, buy. Oh, is it not like that? I don't really watch movies, but I feel like that's pretty close. That's what a lot of people think investing is, and it used to be. Wealthy individuals had to call a broker who charged a commission to buy or sell stocks, but now anyone with a smartphone can go online to zero commission platforms to make trades with $100. Hey, wait a minute, the clever ones among you say, incisively, and also somewhat nasally. If trading all of a sudden appears free, wouldn't the reduced psychological barrier to frequent trading actually encourage more activity, especially among less experienced investors? To which I say, do you also remind the teacher to give you homework? Retail investors refer to individual, non-professional investors like you or me. And in 2020, millions of brokerage accounts were opened by individuals, many of whom novices, on platforms like Robinhood, which gamified trading. So yes, people do still trade like investors in movies, watching the market for slight moves in a single day, or trading options, which you can think of as bets on whether a stock will go up or down. But let's be clear, most people who do this mock reason. Options are theoretically the fastest way to turn $20,000 into $200,000 overnight, and proven to be the most effective way to lose everything you've ever made in a weekend. So, not necessarily what I would recommend for you. Today, most investors gradually buy diversified funds in retirement accounts or simple brokerage portfolios and hold them for years or decades. Why? If you invested all your money in Blockbuster, which no longer exists, you'd say hi to the bottom of a lot of Jack Daniels bottles. If you invested 50% of your wealth in Blockbuster and 50% in Amazon, you'd still probably need to be checked for a brain injury, but you'd be better off. So what if you invested your money in a ton of companies, in and outside America? Gold, real estate, bonds, and other stuff, so Blockbuster's downfall couldn't hurt you. That'd be called busting the Blockbuster blunder. That'd also be called diversification, and it's how investors manage risk. Remember the guys on the boats? Back then, brokers pushed for more frequent trades because they made commission. But for the past few decades, passive, long-term strategies have gone from niche to the default recommendation for retail investors. Has someone irritatingly said to you, time in the market beats timing the market, before, or maybe hundreds of times? Oh, well, I'm honored to be your first. Are you familiar with Warren Buffett? He's like the god of investing. He made a famous challenge to hedge funds where he bet $1 million that a low-cost S&P 500 index fund would beat a portfolio of hedge funds selected by protege partners over a 10-year period. In other words, a simple fund that held the largest 500 US companies and didn't really do anything else. So it had low fees to buy versus professional stock pickers on boats in suits with 3 monitors who charge for their work. If you've been paying attention, you already know who won. The professional stock pickers. Haha, gotcha, you were watching Thirst Traps on TikTok, you goober. No, Buffett's simple fund crushed the hedge fund portfolio overall, and his advice to retail investors was to build a diversified portfolio and sit on it for decades until you retired. Because literal professionals do worse. And lazy investors around the world rejoiced and abounded. And luckily, there are no system-level risks whatsoever to everyone holding the same companies passively. But how much money do you make if you do this instead of, say, donating 1/10 of your paycheck to King Nioh? The commonly purported figure is 10% per year. Now that's on average. It might go up 20% one year and down 30% the next, but over time it evens out to about 10%. And that's pretty cool, right? If you put in $10,000, 10 years later, that'd be about $26,000. The more you put in, the greater your returns, and returns compound, meaning you're not just earning 10% on your original $10,000, you're earning 10% on everything in your investment account. So at the end of year 10, you're looking at 10% growth of $26,000. So if you start passively putting money in the stock market in your 20s and retire in your 60s, you should be the emperor of a large island economy. Let me tell you a secret though. This 10% figure is a bit misleading because it's a nominal figure. As we all know, the price of eggs today will not be the same as 10 years from now. It will become more expensive. When you account for inflation, the real return annually is more like 6 to 7%. You factor in taxes on gains and dividends, fund or brokerage fees, and any emotional moves like selling during a panic or buying at the top, and it's maybe a small island economy. And it's a bit like,
it's one banana, Michael. What could it cost? $10?
to say people can easily invest every week starting at 21 until they retire at 65. And for these compounding effects to really matter, you do need to be looking at decades, not months or years. And with the Fed currently turning the money printer back on, who knows what inflation will look like, but I can tell you this, it won't be less. The most important thing you really need to do to make money from the stock market is subscribe to the King Nioh YouTube channel and follow me on Instagram so I can show off.